Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
S&P 500 is up fractionally. Dow Jones Industrial Average up fractionally. NASDAQ up 0.25 percentage point. Russell 2000 is up 1/5 of 1 percentage point. The VIX is sitting at 24. Seems like all the markets are saying we're not totally convinced there's going to be a ceasefire tomorrow. Bitcoin is more optimistic that there's going to be a ceasefire, trading up 3.4% today to 69,647. Big news out of Strategy buying more Bitcoin. 10-year Treasury sits at 4.33%. Let's talk about the last 72 hours and the next 24 hours. President Trump extended the deadline for Iran to reopen the Strait of Hormuz by 24 hours. But Tuesday's the day. He's calling it Power Plant Day and Bridge Day, all wrapped up in one in Iran. There'll be nothing like it. And then he said, and get this, watch out for foul language coming up. Open the fucking strait, you crazy bastards, or you'll be living in hell. That's wild that the President of the United States is sending that out on a tweet. He followed that message up a few hours later with Tuesday at 8 p.m. Eastern Time. The sources said diplomats from Egypt, Turkey, and Pakistan are working behind the scenes to help the United States and Iran find common ground. In the meantime, a spokesperson for Iran's Central Command said in a statement, if attacks on civilian targets are repeated, the next stages of our offensive and retaliatory operations will be much more devastating and widespread. That was basically the news over the weekend. This morning, an Iranian official said there will be no ceasefire. We do not agree. President Trump on Iran this morning, right before the Easter egg roll event at the White House, came up with some zingers. My family went to that once, many, many years ago when my father worked in the government after his military career. It's a pretty wild event that they're so family friendly. I can't imagine he said this in front of the kids. Let's hope not. But he said President Trump emphasized the core goal of any conflict, preventing Iran from acquiring nuclear weapons. He noted Iran still possesses some missiles and drones and acknowledged a lucky shot by Iran. He expressed confidence that Iranian people would rise against the regime when safe. On a potential resolution, he stated this morning that the U.S. could leave immediately but prefers to finish it up, with war potentially ending quickly if Iran takes certain actions. He described the ongoing negotiations as involving reasonable counterparts, not radicalized actors. He dismissed proposals as not good enough and emphasized the final deadline is Tuesday, 8 p.m. Eastern. He made an offhand remark that taking Iranian oil, if given the chance, that man has never seen a dollar he didn't want to grab. He must have been the ultimate child to the con, putting crazy glue on a quarter and putting it on the sidewalk. So I wasn't here Friday because it was Good Easter, but I did my strategy show, which I hope you like. We had the job numbers come out, and they crushed expectations in March, with the unemployment rate unexpectedly dipping to 4.3%, job growth of 178,000. Economists were expecting 65,000. Now, we are starting to get some inflationary issues cropping up from the higher crude prices, whether it be Amazon putting a 3.5% surcharge on deliveries for their suppliers, or United Airlines throwing on $10 per bag for flights. There's real inflation out there. Gasoline jumping to above $4 a gallon. The February jobs report had been a big disappointment, with jobs unexpectedly contracting and the unemployment rate edging higher. So this report helped. It gave although inside this report, I'll be honest with you, a lot of the job gains were tied towards striking healthcare workers coming back to work. So it wasn't as great as the headlines made it sound. The March jobs report just gave the Fed permission to do nothing while oil prices continue to fuel recession fears. Nearly half the gain in that jobs report, though, like I said, came from health workers returning from their Kaiser Permanente strike that had created the February numbers. So it wasn't a blowout. A trend of weak hiring has kept the door open to easing. The February jobs report had a loss of 92,000. It was revised from 92,000 jobs lost to 133,000. I still can't get over that. President Trump sending out the message that Tuesday will be power plant day and bridge day all wrapped into one. Open the fucking strait, you crazy bastards. There's something funny about that. It's sad, but it's funny. It's dark. My family had a dark sense of humor. One of our favorite movies growing up, as I had 4 older brothers, was Raising Arizona. I'll take these here Huggies and all the money you got in the safe. Diapers are expensive. So the Fed has to figure out what to do with the labor market that suddenly appears to be stabilizing right as oil markets begin to price in an economy that will need support. Data is suggesting that inflation pressure from the labor side is cooling, but no FOMC member will cite cooling wages as a reason to cut. The Strait of Hormuz stays closed through Tuesday for now. New geopolitical and energy shocks could hit the economy just as central bankers become more convinced of staying put. This week we have the Federal Reserve's favorite inflation gauge, the Personal Consumption Expenditures Index. It's going to get an update on Thursday. On Friday, we'll get the Consumer Price Index report for March, offering a look at how prices have fared once the Iran war started. We have a good week ahead. The Masters Golf Tournament, first major tournament of the year, tees off on Thursday. That's the green jacket one. It looks really good on high-definition TVs. If you want to watch all 4 rounds in person, it sets you back $26,000 on the secondary market. It's a pricey, damn pricey ticket. March Madness concludes tonight when UConn and Michigan will face off for the first NCAA men's basketball championship. I guess it's not the first, but the last game. Amazon Prime Video's The Boys debuts its 5th and final season on Wednesday. Euphoria kicks off on Sunday. It's season 3. A lot of TV shows, but we're watching way fewer TV shows. Mizuho is in the news today. They put an outperform rating on Dell, lifted its price target to 215 from 180. But Mizuho also kept Supermicro at neutral and lowered its target to $25 from $33. Supermicro is in trouble with export control laws. Supermicro, though, continues to be a leader in AI server technology, but the federal indictments could shift some orders to Dell. That's why Mizuho analyst Vijay Rakesh, he's lifting his estimates for Dell's AI server orders to $53 billion in the fiscal 2027 and $68 billion in 2028. Mizuho is also saying that all key customers indicate continued willingness to stand up additional AI server clusters. Hyperscalers' eye-watering CapEx numbers are a boon for the entire industry, even if Supermicro may lose some of market share. Agentic AI workloads will drive greater demand for servers. The demand will come from both smaller cloud service providers and enterprise and sovereign data centers, not just hyperscalers. As we move from the large language models into the AI agents, Dell is a big player with some upside. Citi put a upside 30-day catalyst on AMD thanks to the strong CPU demand from agentic AI. Citi kept a hold rating on shares and cut its price target to $248 from $260. Netflix landed an upgrade to buy from hold over at Goldman Sachs. No longer having to worry about the Warner Brothers deal overhang. Netflix can generate sustained low double-digit revenue growth over the next few years. Should be a buyback. They think that a 24 times multiple is appropriate, with a compounded annual growth rate of 25% after the estimate update. So the price target rises by $1 to $96. What's interesting is Netflix, you have to have the question about their ability to retain, grow audience engagement with competition from a range of media seemingly growing, including stronger engagement at YouTube and for free ad-supported TV, and in the rising interest of younger consumers in short creator content on social media. A lot of shows. My kids definitively watch more TikTok and Instagram and YouTube than they do Netflix. JP Morgan is standing pat on its sell rating on Tesla. They still see 60% downside for shares from here, $145 price target. Listen to this. So SpaceX is getting ready to go public, and a lot of people think that Tesla shareholders will sell their Tesla shares and buy SpaceX. Stock's trading around $355, down roughly 20% since the start of the year. JP Morgan analyst Ryan Brinkman released a scathing note following Tesla's first quarter delivery report. 60% downside. He reiterated his underweight price target of 145. The reason was Tesla reported 358,000 deliveries for the first quarter 2026, missing both Bloomberg consensus expectations and JP Morgan's own. Brinkman noted that Tesla is still trading at a staggering PE of over 330, which he argues is completely disconnected from its declining profit margins, now at 18%, and slowing revenue growth. JP Morgan, the broader market, is reevaluating the Tesla premium, they say. Beyond cars, Tesla's energy storage deployments also fell significantly short of the 14.4 gigawatt analysts were expecting. They only came in at 8.8. Some analysts, including those at Goldman Sachs, have flagged that Tesla's plan to spend over $20 billion this year on AI infrastructure, and the Cybercab ramp-up could lead to negative free cash flows for 2026. While the bulls like Dan Ives are still holding on to a $600 target based on the potential of the robotaxi rollout, the show me story is getting harder to sell as delivery numbers have softened. So Wedbush has a $600 outperform on Tesla. Baird has a buy at $538. Truist has a hold with $400 target. JP Morgan has an underweight at $145. I'm pretty sure you could see whichever one you want to see. And I say, I hope it does well because it's in the S&P 500, but I'm not counting on it. Bank of America downgraded plastics maker Dow and LyondellBasell to sell from hold. They've had big run-ups in response to the Middle East supply disruptions. They don't think that run-up can be sustainable. Bank of America downgraded Carvana to hold from buy, cut its price target from $400 to $360. The analyst cited higher gasoline prices and higher short-term rates as reasons for the moves. Piper Sandler upgraded Tyson Foods to buy from hold, with its beef business benefiting from the JBS strike and its chicken operations benefiting from the Koch Foods poultry plant fire earlier this year. Analysts say top-line growth momentum at Tyson is helped by the protein craze, with little GLP-1 disruption risk. Capital One saw their price target cut from $287 to $226, citing pressure on valuations for the consumer financial stocks due to a shakier economic backdrop. That's a stock I really want to own. I just can't get there. I think that makes sense. McDonald's is talking about another buying opportunity. Well, they're not talking about it, but analysts are. At Oppenheimer, Brian Bittner at Oppenheimer said, "We highlight McDonald's 10% pullback from February's all-time high as an actionable buying opportunity." I agree with that. I like 10% pullbacks on names like McDonald's. Boring old companies. They're not going to come out with McNugget 2.0. They're not going to come out with Big Mac 2.0. Oppenheimer upgraded shares to outperform and installed the idea as one of our top picks. We have a bullish thesis with a path for accelerated market share trends and same-store sales upside throughout the year. McDonald's refreshed value strategy is gaining traction, and upcoming beverage launch will provide accretive momentum. Plus, their international strength, 60% of their profits, and unit growth accelerating to greater than 5% remains underappreciated. They have a $355 target on this $308 stock. Morgan Stanley named Seagate Technology its top pick on hard disk drive momentum and margins. Price target is $582. It's currently $429. That's a pretty big call. Coming up, I'm going to talk about what's going wrong in the economy. Got a thing on Fubo TV for you. 2026, poised for another year of double-digit gains. I'll tell you why. And I'll give you an update to the market numbers and see if anything else pulled up that we have to pay attention to. Let's take a break here. Let's remember that I have an event coming up, not this Saturday, but the following. So 13 days, roughly 12 days. Saturday, April 18th, 11:30 to 1:30 in Sunnyvale, California. It's a chance for you who have built up a nest egg to find out what you're doing right, what you're doing wrong. You can help address questions like, am I on track to retire the way I want, or do I need to make changes now? or if you're in retirement, what are you doing wrong? I saw a man with a portfolio at the last Pints and Portfolio that just had too much high-yielding dividends. His plate was full with them. I like my dividends in 2 to 3%. If I want a little bit more growth, I like my dividends at 1 to 2%. Once you get above that 3.5%, you start getting exponentially more risk in the payout of that dividend. I did a segment on it on aristocrat dividend achievers, dividend aristocrats and dividend achievers, and some of the names that are like 15 years into that 25-year march to the aristocrats. I like dividends. That's how I'm setting up my retirement. I'm not day trading. Come meet me in 2 CFPs Saturday, April 18th, 11:30 to 1:30, Sunnyvale, California. Sign up at robblackshow.com.
Join Rob Black in Sunnyvale Saturday, April 18th for Pints and Portfolios, a less formal event at a local watering hole for those close to retirement with $500K or more in investable assets. Drop by from 11:30 to 2 for a little sunshine and a complimentary preliminary financial plan from a CFP that Rob trusts at EP Wealth Advisors. Whether you're on the road to retirement or already there, this preliminary plan can provide you with a second opinion analysis of where you are and highlight areas for improvement and opportunities for growth. That's Saturday, April 18th in Sunnyvale. Go to robblackshow.com and click the Events tab. Find Pints and Portfolios and click to register. You'll answer a few simple questions about your situation, and your confirmation email will provide all the details on the location of this Sunnyvale event and how to schedule your preliminary financial plan. Space is limited and registration is required, so go to robblackshow.com today. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
So the markets have been open now a few hours, and the good news is things are getting a little bit better. The S&P 500 is now up over 0.25%. The Dow Jones Industrial Average up 0.25%. The NASDAQ up 40 basis points, almost 0.5%. And the Russell 2000 is up 1/3%. The SpaceX IPO that's coming up could supercharge the entire space industry. Shares of Rocket Labs, ticker symbol RKLB, surged roughly 10%. Planet Labs, ticker symbol PL, up 10%. AST Space Mobile climbed even more on the news when it was reported that they're in the final stages of what could be the largest IPO in the history, with a target valuation north of $2 trillion. They're calling it a Netscape moment for space. When Netscape came public, the whole internet sector kind of caught fire because it was such a valuable tool in navigating the internet. The internet was this thing that academics and government employees used until it became an industrial grade class of browser. SpaceX's IPO, like Netscape's, will give the industry a lot more legitimacy. The median price for a home in San Francisco is now $2.15 million, jumping 18% from last year. The AI startup boom is pushing what was already one of the most expensive housing markets into dizzying new heights. The median price for condos in the city jumped 27% to reach $1.36 million. OpenAI is on track to burn $85 billion in 2028, but they expect profitability by 2030. That's a wild switch. Anthropic and OpenAI are racing to go public this year, and all eyes are on how long they can sustain burning billions in cash before they achieve something that looks like a viable business. OpenAI expects to burn tens of billions of dollars per year for the rest of the decade, peaking at $85 billion in 2028. Anthropic will also continue to burn cash for years, far less than OpenAI, but it projects that 2026 will be its biggest year of losses. It targets 2029 for profitability, fueled by exploding enterprise revenue. And right now, they are winning the enterprise. Memory stocks are still doing their thing. Micron's up 4% today. Western Digital up 3.99%. Let's call it 4. SanDisk up 2.87%. Seagate Technology, ticker symbol STX, up 5.9%. Morgan Stanley reiterated its confidence in hard disk drive sellers, saying that the recent channel checks point to strengthening demand, elongating visibility, and more importantly, a much stronger pricing outlook. I told you in the last segment that Seagate got that upgrade to $582 price target from $468, and Western Digital $380 from $369. Super Mario Galaxy Movie delivers holiday weekend records for theater chains. AMC stock is up 16% today. Cinemark is up 2.4%. Nintendo's up even. The Yoshi popcorn bucket has pushed Mario Galaxy into the second best merchandising program ever for the theater chains, behind only Taylor Swift Eras tour concert film. Mario-themed glitter popcorn and other food items tied to the title have already resulted in the most successful merchandising program at Cinemark. That's crazy. Mario Galaxy pulled in $190 million domestically, $180 million internationally, for $370 million over the 5-day weekend. Now, domestically, it underperformed the first movies, which was pulled in $204 million, versus this one's $190. Applied Optoelectronics jumped today after Hyperscaler more than doubled its recent order. Optics are hot right now. Now, Coherent and Lumentum are down today, but Applied Optoelectronics are up 6.4%. It's an optics and networking company that announced a key customer ordering an additional $71 million worth of 800 gigabyte single mobile data center transceivers. Taking a look at the market numbers today. There's ceasefire uncertainty as President Trump's Tuesday deadline for Iran looms ahead. Stronger than expected March jobs report that was released on Friday is getting some play today because the markets weren't open on Friday. Broader market is modestly higher. The NASDAQ is up a little bit more. Relative strength worldwide in South Korea, ticker symbol EWY, up 2.1%. India up 1.4%. U.S. healthcare, ticker symbol AHF, up 1.1%. Chile up 1%. Fubo TV is in the news today. They're jumping as their EBITDA outlook, ad strategy, and FCC developments boost the bull case. Ticker symbol Fubo, F-U-B-O. They do sports. That's their whole streaming platform, sports, and a lot of them. They're a key driver in the long-term outlook is Fubo's Hub commercial agreement, which is expected to expand distribution, improve subscriber acquisition efficiency, and enhance monetization opportunities across its platforms. If blackout-related rules are loosened or rewritten, it could expand access to live sports across streaming services like Fubo, potentially increasing engagement, reducing friction for subscribers, and improving the value proposition of its sports-first bundle. Fubo's long-term targets mark an important step in the shifting and narrative march towards profitability and financial sustainability, which has historically been a key investor concern. The combination of its hub agreement and transitions to the Disney ad server highlights a more sophisticated monetization strategy. These initiatives, along with operating leverage as the business scales, underpin its confidence in achieving positive adjusted EBITDA by 2026 and expanding profitability into 2028. Execution remains critical, particularly in driving subscriber growth and ad monetization. Stock is rallying big today. Investors are gaining confidence in Fubo's internal strategy and potentially more favorable industry structure. Jamie Dimon is in the news today. He wrote his letter, his annual letter. And he said, skunk in the market, skunk at the party. Who wants a skunk at a party? He pivoted away from the cockroaches and towards skunks in his latest letter to JP Morgan Chase shareholders. His worry, the ongoing wars in Ukraine and Iran, could drive up inflation and trigger a stock market sell-off this year. The skunk at the party, and it could happen in 2026, would be inflation slowly going up, not slowing. What's wrong with me? As opposed to slowly going down. This alone could cause interest rates to rise and asset prices to drop. Interest rates are like gravity to almost all asset prices, and falling asset prices at one point can change sentiment rapidly and cause a flight to cash. His letter to shareholders is probably as well read as Warren Buffett's. Traders are pricing in an 81% chance that the Federal Reserve holds interest rates steady at 3.5% to 3.75% between now and the end of the year. A month ago, those odds would be that of policymakers would keep rates unchanged to just 14%. Dimon flagged high global sovereign deficits and debt and ongoing worries about the private credit as other risks that pose a threat to the market. Dimon named the Trump administration's signature tax and spending bill, the Fed's monthly purchases of Treasury bills, deregulation, and the boom in capital spending on artificial as 4 tailwinds that could support asset prices. 44 years old. That's the average age of a home in the United States. So when millennials go to buy a home, They're going to have to throw paint on that wall. They're going to have to fix wires and roofs and water heaters and pipes and all sorts of stuff that can be expensive. Structural repair costs increased about 14% in real terms in the last 3 years. Homes aren't getting any younger, especially with people reluctant to give up interest rates on their current mortgages. In theory, Home Depot, Williams-Sonoma, and Lowe's should be obvious investments, but those interest rates are making it difficult. 2026 is poised for another year of double-digit gains, despite recent volatility. Stocks have been under pressure over the last month. They're showing some signs of life. They're showing some signs of losing the exasperation and getting back to acceleration. A pullback is defined as a decline of 5% to 10%, and they happen on average 3 to 4 times a year. When corrections are defined as a decline between 10 and 20%, they happen on average about once a year. As painful as they are, they're very common. It's also important to remember that geopolitical conflicts and events usually only have short-term impact on markets. Over the last 40 years of geopolitical shocks, markets usually bounce back quite fast. And historically, they are typically higher 12 months later. Same goes for 6 months. Even the 3-month outlook leans positive. The small cap Russell 2000 and mid cap S&P 400 are back in the plus column for the year, with year-to-date gains of 1.94% and 3.12%, respectively. The small caps are having a good run. The tech-heavy NASDAQ, which led the indices last year with a 20.4% gain, and the S&P 500, which was up 16.4%, have lagged this year as concerns over AI capital expenditures have weighed on tech stocks. Stocks like Microsoft, Alphabet, Amazon, and others have fallen sharply this year. Headlines are pointing to increased capex as the culprit, with people wondering if these investments will ever pay off. Companies like Alphabet, Amazon, and Microsoft used to not have a lot of debt or hard assets like data centers. Now they're leaning into it. So to say that a company with no hard assets or few deserves a 30 times PE, what does a company that's saddled with a lot of hard assets? What does that say? It should be around 20. So I think it should be a lower valuation. But these are the guys who are earning the big bucks too. In addition to the ongoing AI boom, there's a myriad of other reasons to expect another year of big gains, including tamer inflation reports, the resiliency of the economy, surging productivity, and the expectation for lower interest rates, to name a few. Last year, the S&P 500 saw a 16.4% gain. That was on top of 2024's 23% and 2023's 24% gain. The historic tech boom led by AI played a large part in sending stocks higher. It reminds me of the tech boom from 1995 to 1999 when the market surged double digits each year for 5 long, glorious years in a row. The tech boom back then saw everybody go nuts for tech stocks, driven by the internet and .com companies. It was new and exciting. The internet was forecast to change the way people shopped, did business, and interacted with each other. The promise was real. It did play out like that. The AI trade is alive and well. It'll likely be one of the key drivers for stocks for years to come. A recent comment underscoring the AI trade came from AMD CEO Lisa Su, who characterized the demand for AI as insatiable and said her company alone could grow by 35% a year for the next 3 to 5 years. She said the AI market is faster than anything we've seen before, and she predicted the AI data center market could grow to $1 trillion by 2030. Here's a few more quotes from Jensen Huang. AI is the most powerful technology force of our time. He also said AI will revolutionize every industry from healthcare to transportation. He also said we're at the beginning of a new computing era. That's a lot of hype. It transforms the world as we know it. It also has the potential to transform one's portfolio. There are plenty of other catalysts that make this market outlook even more exciting. We'll talk about it in the days and years to come. Planet Labs jumped last week. It's up over 800% in a year. It operates tiny satellites that take images of Earth. It's handy in the midst of 2 major conflicts. What's cool about it is they sell these charts. And they could be valuable to farmers. They could be valuable to generals. A few days ago, over 100 Baidu robotaxis halted on highways in Wuhan, China. The second mass robotaxi failure in a little under 4 months. These incidents show us Weird how these centralized cloud systems make robotaxis especially vulnerable to shutdowns. They also reveal the lack of clear contingency plan when an army of driverless cars goes dark at once. The driverless cars didn't pull over into an emergency lane. They halted where they were. Some in the fast lane with traffic streaming by on both sides. Robotaxi systems are generally designed to pull over to a safe location when something goes wrong. In this case, they didn't. And it's not clear why. It took some 30 minutes to even connect to a customer service rep. Help never came. Robotaxi companies run their fleet on a centralized cloud with shared systems for routing, navigation, and remote assistance. When there is a hiccup in infrastructure, it can take down a large number of connected vehicles. Last year, when a massive blackout in San Francisco knocked out the city traffic lights, Waymo's traffic fleet of robotaxi caused a traffic jam. The cars are supposed to handle dead traffic lights on their own, but they're also programmed to occasionally ping Waymo's remote assistance team for a confirmation check. In the US, Waymo is now doing 500,000 paid rides a week and targeting 1 million by the year's end. I got to start getting ready for the afternoon podcast, get some research done, do some reading, grab a quick 30-minute lunch, come back and do a show. Pints and Portfolio coming up Sunnyvale, California, Saturday, April 18th, 11:30 to 1:30. You can sign up for it at robblackshow.com. That's robblackshow.com. Are you on track to retire the way you want to? Or do you need a few changes beforehand? It's a very informal event. I'll buy the beer. And I'll see you there. Sign up at robblackshow.com. That's Sunnyvale, California, April 18th, 11:30 to 1:30.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.